All right, I am back. I recorded a video on Friday, but my mic wasn't on and I didn't feel like doing it again. I just rolled, what I did was I rolled some Amazon put credit spreads because Amazon was, or because the market was down, and your put credit spreads, you get more credit when you roll it, and then you can also reduce your risk. And I'll show you this on Apple today. But look at this market, up 1.1% off of this 43.30 level. Like I said, it looks like it picked a direction because it was hovering around that 43.30, and I thought it was going to break to the downside again, but we're right back over that level. It's awesome. Awesome, awesome, awesome. So let's talk about the difference between put credit spreads and poor man's covered calls, or uh, call debit spreads. Okay, so let's look at this DBX. Remember, I sold my DBX, my Dropbox. Sold my Dropbox stock. Uh, did a poor man's covered call on it, which means I bought this January 25 call for $400, and I got rid of what? I got rid of 20. I got 2,800 on the books. Then bought this $400. So $400 is a lot better than 2,800, obviously, to hold on to this. But I did it to cover this October 28 call. So this is actually in the money. And this is going to expire this week. See, it's 20 October. It's going to expire this week, and hopefully it's not in the money, because guess what happens if it's in the money? If this is over 28 by the time Friday closes, then I'm going to have to come up with shares to sell this person. Now, where do the shares come from? Well, I would have to exercise this call. When I exercise this call, then I get shares for $25. So I'll spend $2,500, buy these shares, and then turn around and sell them for $2,800. That sounds good to everybody, but here's the problem. I only got, what, $45? No, $35 for this call, but I spent $400 on it. So here's the math. 2,500 plus 400, that's 2,900, minus $35, 29 minus 35, so that's 28.65. So this trade right here, if it's in the money, I'm going to lose $65 on it, because I'm spending 2,900 and then I only got back 3,500, and then I'm selling it for 28. So I'm going to lose $65. That's 65 cents a share I'm going to lose, which I'm not excited about. But here's the other thing. If this expires out of the money, then I pocket all this 35, it expires, and then I get to sell another call on this 25 shares. Okay, and I could sell the call as low as, I would sell the call at 29. I would sell the call at 29, roll it up, and then I would break even. Actually, maybe I can roll this call up to 29. Let's create rolling order. This just came to me. This may be a good idea. Let's see what it looked like. Roll it to 29 for an additional week. It debits $25. But it'll debit $25. However, it will lower my, instead of losing $65, I only lose $25. So that's what I can do. Or actually, if I move it to November, I get a credit of 15. So I think that's what I'm going to do. I'm going to not chance it. I'm going to take this 28, roll it to 29, and that way it'll give me a little more cushion. It'll give me a couple more weeks. And then if it triggers at 29, I won't lose that 65 cents a share, and I'll get 15 cents credit. I'm glad I thought of this. So let's roll that out a little more. And that's why you buy deep in the money, and that's why you roll it out. I did it all the way to January. Now, if I would have bought the cover, if I would have bought that call for November, I wouldn't be able to do this because I wouldn't be able to exercise it. So because I cancel it, okay. So because I bought that deep in the money call way out, then I was able to do that trade and save myself a little bit of pain on that $65. So now I made a little money. Now let's look at another issue. Let's do monitor. I'm only at 5 minutes. So I got another business loan, but it was stocks, which stock you can loan stock. And the reason you can loan stock is because I'm on margin. And so even though I can't sell out of the stock, I can use that to for additional buying power. So that's why, and my cost basis is all messed up. The cost basis haven't transferred over yet. So it's a little bit confusing, but Apple right now is down, and the reason why Apple's down is because they had weak sales in China, and it's not even down that much. China, it turns out, deceives a lot on their economy, and so when we actually find out the truth, then it goes really badly. So this is what I did on Friday with my Amazon. I'll create a rolling order because puts are more valuable when the stock is down. So I'm going to create this rolling order. I'm going to go to 40, 140. Then I'm going to keep it at December. So that's going to debit my account $19. That's fine because I'm going to show you what I'm going to do on the back end. Debit the $19, control and send that. And then I'm going to take the call that I sold, or the put that I sold right here for 155. And I'm going to roll it to 160. So what I did was I saved $1,000 in risk. That's not going to let me do that. Yeah, I saved $1,000 in risk, and I'm only taking on an additional $500 on risk. So I'm saving a total of $500 on risk, and I'm pocketing $30. And I'll be able to buy Apple at 160 if Apple drops that low. Let's go, boom. Now, for Apple to drop to 160 by the end of this year, something catastrophic would have to happen. So, managing my spreads today, my poor man's covered call, or my debit credit spreads, or my put or debit or my put credit spreads. Yeah, it gets kind of confusing. So that is it. That's the video.